There's been a lot of chatter recently about the financial system's surface cracking and how gold and silver could be affected when most people aren't looking. Therefore, we will distinguish between signal and noise in this video. Additionally, you will leave with a far better understanding of what matters, what doesn't, and what you ought to see next. According to New York Time, it is Sunday, February 22nd. Would you kindly let me know what day and time you're viewing from? I'm always interested in how far these films travel. Additionally, if you appreciate the work I spent analyzing the data and putting this information into understandable terms, please subscribe to the channel and leave a remark for our future ledger Anna. This is important since the metals discourse has evolved. It's no longer merely up or down. What will be the next domino to fall? And three large buckets are being pointed at by several. The massive surge of borrowing associated with the AI build-out, the short-term funding plumbing, and the international leverage trade that many are unaware even exists. This is where the twist lies. To shift markets, none of these buckets need to blow up completely. Sometimes all it takes is a little sway, a few rough weeks, some less than ideal options, or a large borrower that is unable to refinance. That's all. The spark is that. Then everyone starts to give a damn. Now, let me introduce what we have been hearing. Most likely, you've seen the hot takes and the vids. Silver can't be stopped. The only secure haven is gold. It is a rigged system. There will be a crisis. Then unwind the following day. Everything is all right. It's whiplash. I called in an experienced money manager to discuss all of this because of this. Metals, interest rates, debt, artificial intelligence, and the areas of the market that most people overlook. We will discuss the main conclusions. Additionally, I'm going to question a simple narrative that seems plausible at first but breaks down when you stop to think about it. Quick housekeeping first, though, as I prefer to keep my word, and I promise to do that. We're holding another silver giveaway for February. We distributed approximately 11 ounces back in December. It was about 22 in January, and it's currently the largest yet. One winner will receive about 31 ounces from my own hoard. To get in, make it easy. Please hit like, subscribe, and comment with either your preferred method of stacking silver or your prediction for the next silver head. I'll choose based on the comments. I wish you luck. Well, let's get back to the actual tale. This was essentially the first thing the visitor said when they arrived. I spent a lot of time feeling optimistic about metals. I still like some exposure to gold, but as the move became overhyped, I pulled back from silver and platinum. You felt it too, so I understand exactly what he meant. Something ceases to be about fundamentals for a while when it becomes a crowd trade. Emotion, FOMO, social media hype, and others swarming in because they saw a headline or chart and don't want to fall behind are the main factors at play. Look, there are good reasons why people are interested in silver. In electronics, it is utilized. Industrial demand is linked to it. Energy infrastructure is connected to it. Indeed, it is discussed in relation to chips and data centers. It's not fantasy at all. However, there is a distinction between an overheated trade and a genuine subject. He therefore witnessed what he had seen before when the price quickly increased, rising from the low 20s to well over $100. Such a sharp move usually requires a pause. Markets don't always move in straight lines, which isn't to say that the long-term story is dead. After lunging, they take a break. They run and then walk. He called the current zone a chop for that reason. Back and forth, sideways, a market catching its breath. This is where most folks go wrong. They assume it's uninteresting when they hear sideways. Then they become inattentive. The following move is set up at that precise moment, because the major twists typically occur when you're fed up with observing, irritated, and certain that nothing is occurring. He responded, "Okay, what are the hidden pressure points for this year?" and gave a list of 3, rather than spending the entire day gazing at the candle chart. The first is the repo market, which is essentially the plumbing for overnight lending that keeps everything running smoothly. The second is the yen carry trade, which is simply the practice of international investors taking out low-cost loans abroad and utilizing them to purchase riskier assets. The third is the genuine AI investment wave, which is likewise drawing a lot of leverage and private borrowing in potentially problematic ways. He also discussed his positioning before we get into the frightening stuff, which I believe is helpful because it demonstrates what a seasoned trader does when the headline noise gets deafening. He claimed to have moved a sizable portion of his exposure outside of the U.S. Through gold, he maintained a toe in the metals. He continued to work in defense and aerospace. And he has been considering areas such as India as having the potential for long-term growth, particularly when the U.S. cycle appears to be crowded and late. Additionally, he stated that he has been leaning toward the long end of the bond market. In other words, until there is a true recession, he is in a position for long-term interest rates to remain stable or even rise. When deficits are large and the bond market needs to process a large amount of supply, that is a more common posture, but it is not a popular one when people are accustomed to rates always falling back down. One of those words that sounds scary is the lengthy end of the bond market line, but if you translate it, it's actually rather easy. The cost of renting money for a few months is comparable to short-term rates. The cost of renting money for 10, 20, or even more years is comparable to long-term rates. I think long-term borrowing costs have reasons to stay high or even rise unless the economy slows hard. Why would anyone think that? That is what people truly mean when they say they're betting against the long run, because the central bank's actions next week aren't the only factors influencing long-term rates. They have to do with expectations. Expectations for inflation, growth, and, this is a big one, the amount of borrowing that the market must take on. Here's an example. As a landlord, you may agree to a consistent rent if you know your renter would likely extend for years. However, you demand a higher rent to absorb that risk if you believe the renter's income is unstable or their spending are increasing. The same is true for bond investors. When they are less confident or when there is a large supply of bonds, they demand a higher yield. And keep in mind what we just discussed. According to official estimates, there will continue to be significant deficits and rising interest rates. This is where it becomes crucial for gold and silver, so it's not absurd for a trader to say, I don't see long-term yields collapsing without a recession. The majority of individuals believe that higher rates are detrimental to metals. It is occasionally, particularly when real rates are increasing. However, the crucial term is real rates. The real rate is simply the interest you receive less the inflation you experience. A positive real rate is achieved when rates are 5 and inflation is 2. It is essentially 0 if rates are 5 and inflation is 5. It is negative if rates are 5 and inflation is 6. Additionally, traditionally, gold has benefited from negative or declining real rates. I'm not arguing we're stuck in a single scenario, though. Because there are several possible outcomes for the hidden crisis scenario, I'm suggesting that you need to understand which lever matters. In the first scenario, growth is stable and inflation declines. In that scenario, metals can fluctuate while risk assets perform their duties. The central bank can maintain its stability, and real rates can continue to rise. In the second scenario, growth slows while inflation remains persistent. The untidy one is that one. In that context, the term stagflation is used to describe a situation in which prices continue to rise, yet the economy appears to be stagnating. In that scenario, hard assets typically remain relevant while policy becomes constrained. In the third scenario, there is a significant slowness due to a malfunction in the credit or finance system. There is a brief sell everything phase in that planet where even silver is impacted. After then, there may be a second phase in which the policy reaction manifests and metal prices sharply recover. This is the reason I keep stating that sequence is important. Recall that the initial wave of the pandemic or the early phases of 2008 focused more on raising money than on prudent long-term deployment. They sold what they could. Because of this, even though gold later performed as expected, you saw it sink momentarily during those times. You must therefore be emotionally ready for that volatility if you own silver. If not, you'll act in the same manner as everyone else. When you can no longer bear it, you will sell at the worst possible moment. Let me now provide one more new piece of background that connects the rate narrative with the fiscal story. The official outlook goes beyond just stating that deficits are significant. Additionally, it demonstrates how interest expenses are increasing to the point where they rank among the budget's highest lines. Because it alters incentives, that is significant. Arguments for limiting long-term returns or otherwise affecting the long term start to surface when interest expenses start to account for a sizable portion of spending. It is sometimes referred to as yield management. It is sometimes referred to as yield control. The name is irrelevant. The idea is to prevent long-term rates from increasing excessively. Am I correct in assuming that will take place tomorrow? No. You should know why people even discuss it, I'm suggesting. The reason for this is that the conversation gradually moves there due to the math. And since it tends to drive down real rates, if you ever did get a version of that, it would probably be good for gold. Therefore, it makes sense to listen to the guest discuss being strategic, exercising patience, and holding some gold as a hedge. He isn't attempting to guess the headline. He's attempting to adapt to the surroundings, and that brings us full circle to what is frequently a prudent allocation of precious metals: a canopy. You enjoy poor weather, so you're not buying it. The weather is the reason you're purchasing it. All right. Let's now discuss those 3 pressure points, as this is where the concept of a concealed crisis either makes sense or fails. Since the repo market is the one that most terrifies people due to its enigmatic nature, let's start there. The abbreviation for repurchase agreement is repo. To put it simply, it's an overnight loan with collateral. One large organization requires money for a day. Another organization lends money using what appears to be treasury collateral. It resembles a pawn shop for very costly paper. You receive cash when you turn over collateral. Tomorrow, you vow to undo the trade. No one discusses it when the repository is quiet. Stress in the plumbing causes greater funding prices, forced sales, and startling why everything is dropping at once moments. So when the repo is stressed, you can feel it everywhere. The reverse repo facility is a related item that most people mistake for a repository. Reverse repos might be compared to a huge cash parking lot. Money funds and major players can park surplus cash with the central bank overnight in exchange for secure collateral while it's lying around. This is the new information based on numbers that were just released. It's almost empty in that parking lot. Lately, the daily take-up has been less than $1 billion. And that sounds crazy if you recall the previous several years, as the building used to be enormous. The reservoir was enormous. It's essentially a puddle now. Upon seeing that, people may, but not always, conclude, aha, there's no buffer left, the system is about to snap. Because this is where people go wrong. They handle a snapshot number as though it were the entire narrative. At this point, I'll use an analogy that clarifies the reasoning. Consider yourself observing traffic on a freeway. You only notice a few automobiles when you take a single picture. You come to the conclusion that no one uses this highway. That is absurd, isn't it? Because traffic is a flow rather than a static image. The same is true of money markets. All day long, cash is moving. Throughout the day, collateral is in motion. Flows are important. The true question, then, is what took its place when you see reverse repos take up low? Was the money transferred to treasury bills? Was it transferred to bank reserves? Was it transferred to another short-term fund? And how are those fluxes affected by stress? I will now make the analogy more precise. Repo is the pipe's pressure. The pressure tank is the reverse repository. When the city is quiet, the tap continues to run even if the tank is low. However, the tank becomes important when everyone turns on the tap simultaneously. When do the times occur when everyone turns on the tap? Around the conclusion of the quarter and the year. On the days of the large settlement. Around high-risk occasions when people sell their positions and raise money. These are the times when something that was fine yesterday turns into a reason why funding has suddenly become costly. I'm not saying that a repository crisis is inevitable, though. The notion that every low reverse repo print should be viewed as a doomsday countdown is actually one of the things I'm fighting against. However, I'm telling you that if you're watching gold and silver, you should be aware of how tight the plumbing is, because metals can respond to that tightening in real time. Now, how does the dashboard now appear? First, as we just mentioned, the reverse repo cushion is tiny. Second, at almost $6 trillion, the central bank's balance sheet is still enormous, and it wiggles from week to week. It's neither a tidy straight-line shrink nor a straight-line explosion. Third, the fiscal side is causing a high issuance environment, which is significant because it influences the amount of collateral and funding demand that enters the system. This leads us to the next layer, which consists of debt, deficits, and the expenses associated with carrying that debt. Since the interest charge is the one that hits you, people often talk about debt as if it were a single, large sum. According to the most recent official estimate, net interest expenditures are expected to increase from approximately $1 trillion this year to slightly more than $2 trillion by the middle of the 1930s. And here's another way to think about it. Over time, interest is expected to account for a larger portion of revenue. In other words, a larger portion of each tax dollar is used for previous borrowing rather than for present services. I want you to experience that now without becoming disoriented. You would soon notice it if the credit card bill for your household continued to rise annually. The bill would still overshadow everything else, even if your income increased little. At the national level, higher interest rates do that. They limit flexibility, but they don't end the world right away. And policymakers find themselves in a tight spot when their flexibility is curtailed. You can hear the debate the guest was implying at that point. Can the central bank actually ease if inflation remains sticky? But does something break if rates remain high? The whole point of the game is that tension. Now, let's anchor this with a new concrete baseline. This fiscal year is expected to have a deficit of slightly less than $2 trillion. Total deficits are expected to reach the low 20 trillions during the following 10 years. And by the mid-30s, public debt is expected to reach about 120% of GDP. Those are not just any viral post, those are official estimates. But once more, keep in mind my skepticism. Large numbers don't always portend disaster. How and at what price the bond market takes it in is the question. Because debt service increases when yields increase. Deficits increase when debt service increases. More bonds are issued when deficits increase. Furthermore, even before anything breaks, that feedback loop might tighten circumstances. What connection does this have to gold and silver then? It connects in a straightforward manner. When trust in paper promises wanes, real rates decline, or people anticipate that officials will opt for simple fixes later, gold and silver typically perform well. However, if liquidity tightens, metals may also suffer short-term consequences. The plumbing story is important because of this. It's sequence, not either-or, and most folks miss that sequence. All right, let's move on to the yen carry trade, which is the foreign leverage bucket. Because it hides behind straightforward headlines like stocks up or stocks down, this one is cunning. In essence, the carry trade involves borrowing money in a currency with a low interest rate and purchasing higher-yielding assets abroad. It functions best when there is no volatility and the funding remains inexpensive. When foreign policy shifts, the value of the currency fluctuates, or risk sentiment shifts, it may unwind. Furthermore, there have recently been reputable talks concerning Japan's normalization process and the reasons it may cause hiccups for carry trades and international liquidity. You can comprehend the risk without being a currency trader. If a big chunk of global money has been using cheap funding to hold risk assets, and that funding gets less cheap, you can see forced selling across markets. Sometimes it's a trapdoor, and other times it's gradual. And you understand what I mean whether you experience the early epidemic shock or the 2008 era. Market sentiment can shift abruptly within a week after feeling steady for months. Let's move on to the third bucket, which includes the debt associated with the AI build-out. Because it is connected to an intriguing narrative, this is the one to which individuals feel an emotional attachment. Leverage is real, but so is AI. And since the guest's message could be misinterpreted, this is where I want to slow down. He wasn't implying that AI is stupid. He was stating that there is a timeless warning that the investment wave may surpass the cash flow. It has been observed in railroads. It has been observed in DOT. It has been observed in housing. There is a consistent trend. Fragile pricing is the result of actual technology plus excessive leverage. This is what recent market updates have been revealing. The financial requirements are massive. According to a recent overview, AI aspirations could lead to the issuance of approximately $1 trillion in debt in a single year, with the largest operators investing hundreds of billions of dollars. However, that does not imply that a bubble would inevitably lead to a crash. It indicates that the system is becoming sensitive. It implies that one lost earnings season may have a greater impact. It implies that a single lender's withdrawal could have an impact on an entire chain. Additionally, we've already seen instances where financing for data centers became unexpectedly more difficult and where private credit products are scrutinized for liquidity and redemptions. Here is some fresh context that is important but wasn't included in the conversation. Many analysts predict that demand for data center capacity will continue to increase. Additionally, they note that a large portion of new capacity is pre-leased, which helps reduce the number of vacant facilities. However, because it links the system to a smaller set of very large counterparties, it also raises the risk of concentration. Therefore, there is a risk even in the bull situation. The entire chain is affected if the large tenants cut back on their expenditures. Since a large portion of the funding has been moving here, let's now include private credit. Over the past 10 years, private credit has expanded significantly, and some mainstream credit experts have characterized it as an asset class that is on par with other significant credit markets in terms of size. Furthermore, according to a different credit outlook, the market's assets under management have increased to just over $2 trillion in recent years. Once more, the purpose isn't the precise penny, so I'm keeping this conversational. The scale is the point. There may be a scheduling mismatch in a multi-trillion-dollar loan ecosystem that isn't traded minute by minute like public bonds. Until they are compelled to change, prices may appear constant. Thus, consider private credit in this way. Although the restaurant has a large menu, the kitchen moves slowly. Prices in public markets change often. Prices in private credit may be sticky. Up until a shock occurs, that stickiness feels reassuring, and then the repricing occurs gradually. What does this signify for everyday people then? Hiring will slow down if a wave of leverage is funding a lot of expansion and that financing gets tighter. Consumer confidence declines when hiring slows. Spending decreases if consumer confidence declines. Additionally, there is proof that household delinquency rates have been rising since the post-pandemic lows, indicating that consumers are not unbeatable. It's not a forecast, it's a condition. Let me now ask you a question that may seem straightforward, but it holds the secret to everything. When the next wobble occurs, do you believe the markets will be supported once more? Or will they tighten up and endure the pain? Because the consistent pattern of policy responses, rather than a single crash, is where metals get their long-term tailwind. By the way, policy includes fiscal decisions in addition to rates. The uncertainty around the evolution of borrowing needs is increased by the current news, which serves as a reminder that changes in tariff revenue and policy decisions can quickly alter the deficit math. Again, more moving parts, not doom. All right, the pressure points have now been discussed. The guest's playbook is helpful here, so let's discuss how to think about posture. He isn't tied to a single story to start. He is strategic. He won't chase, but he will own metals. When the move becomes too heated, he will move aside. When the arrangement makes sense again, he will re-enter. Second, he has a global perspective. His attention is not solely on the US market. That's why he searches abroad. Furthermore, you don't need to be an expert to comprehend the appeal of India in particular. It's a big economy with plenty of room to grow. And international organizations continue to predict that emerging markets will make a significant contribution to growth in the years to come. Third, he favors industries like aerospace and defense that stand to gain from long-term government demand and changing security goals. Furthermore, disputes over defense funding and modernization initiatives can result in multi-year order backlogs in that industry, regardless of political affiliation. Does that imply that defense should be purchased at any cost? No. It indicates that he is searching for markets where demand is not as dependent on a particular consumer cycle. Oh well, since you're here for metals, let's bring it home. The guest's advice on core metals was surprisingly straightforward. A portion of your wealth should be kept in actual gold rather than just claims on paper. Additionally, make sure information is organized so that you can access data without relying on a third party. He didn't say go Allen, as you can see. A slice, he added. A hedge, a disciplined allocation. And even if your precise proportion may differ, I agree with that idea, because most people don't want to win big when they go for gold. It's to avoid being destroyed if the world becomes strange. He was much more tactical on silver after that. He said, I don't feel the need to chase the chop, but I want to be involved when the next big leg starts. That's a mature strategy because people become emotionally stuck when they chase vertical moves. They persuade themselves that metals are a hoax after buying high, selling low, and panicking during the pullback. No, the trick was their timing. I sincerely want you to respond to this question in the comments section. Do you believe the AI debt tsunami or the plumbing repo and liquidity will cause the next significant market tremor? And since I'm interested, a second one. Are you waiting for a more tranquil entry or are you already stacking metals? Additionally, if you're successful, tell others about it in the comments section to keep them inspired. Now, for those who are unfamiliar with this video, a brief mid-video pause. We have a reliable partner that provides free consultations if you're considering physical metals and want to learn the fundamentals like pricing, storage, and how to avoid glaring errors. I won't mention any brands here. You can see it by simply reading the description. Also, remember to check the social media accounts mentioned in the description if you would want to receive more updates in between videos. In addition to being a handy spot to take brief notes when anything fails, we regularly update fresh stuff there. Since it's easy to misunderstand, I want to address one more point that came up in the chat before we close up. The guest discussed the desire for markets to return to reality, for there to be a rebalancing, for Main Street to not be crushed while Wall Street floats. When they hear that, many people assume you want to crash. It doesn't have to mean that. A lengthy adjustment period, increased savings rates, less cheap money, a greater emphasis on real cash flow and profitable investments, and a decreased emphasis on financial engineering are all possible outcomes. In the long term, those changes are healthy, but they are uncomfortable in the near term. Metals can still be useful if that's the future we're going into, but not as a lottery ticket, but rather as a component of a well-rounded strategy. Now, for those who wanted to know where more of the guests work, he manages his own website, hosts a podcast on a regular basis, and provides portfolio management services to eligible investors. To make it easier for you to find, I will include the information in the description rather than saturating the screen with links. What does that leave us with then? We are left with a world in which there is more than one hidden catastrophe. There are a number of pressure points, a system of finance that may become tight when the buffers are depleted, a route toward debt that is mathematically significant even if the end of the world is not imminent. There is a genuine AI investment boom, but it is also attracting leverage and private borrowing in ways that may cause anxiety if returns are not satisfactory. Additionally, when policy changes, the foreign finance trade may unravel in unflattering ways. Since predicting the precise day something happens isn't the purpose, if you grasp those, you're already ahead of most people. Knowing how the dashboard appears will help you avoid being caught off guard. Don't allow fear control you. Instead, remain patient and inquisitive. I appreciate you seeing, and I hope to see you in the next film. As always, this is not financial advice. Rather, it is instructional information. You are in charge of your own choices, your own risk, and your own research, but I'm presenting how I interpret the headlines and the data.